Welcome to the tokenized economy. In today's explainer, we're diving into the crucial difference between self-custody and institutional custody. It really all comes down to one thing: who holds the keys to your digital assets? And as you're about to see, that choice, well, it changes everything.
Okay, so let's start with the absolute foundation of all of this. In any blockchain system, ownership is defined by what's called a private key. You can think of it as the ultimate, unhackable password. It's the one thing that lets you sign transactions and prove you actually own your assets on the network.
So, this leads us to a really practical and super important question. If these keys are so powerful, who should be the one holding on to them? The answer to this question really shapes the entire experience and, the risk of owning any digital asset.
And there are basically two main answers to that question, which have led to two totally different models. You've got self-custody on one side and institutional custody on the other. So let's break down what each of these really means.
First up, we've got self-custody. Now, the easiest way to think about this is with that classic crypto saying, be your own bank. It's a model that is built completely on direct individual control.
What this means in practice is that you, and only you, have access to that private key that controls your assets. There's no third party, no company, no administrator in the middle who can do things on your behalf. You have the final say. Period.
You see this model in action all the time with software wallets like MetaMask or Phantom. And for people who want even more security, many use hardware wallets. You've probably heard of Ledger or Trezor devices, which keep those precious keys completely offline. And this really gets to the heart of the whole self-custody model. The principle is super straightforward. If you control the private key, you control the asset. This gives you the ultimate autonomy, right? But it also means that all of the responsibility lands squarely on your shoulders. And that responsibility is no joke. I mean, if you lose your private key, your assets could just be gone forever. If it gets stolen or compromised, any transaction signed with it is totally irreversible. There is no customer support line to call, no one who can reverse it for you.
So, what's the alternative? Well, that brings us to our second model, institutional custody. This approach is less about being your own bank and a whole lot more about trusting the experts to manage all that complexity for you. In this model, instead of holding the keys yourself, you basically entrust them to a regulated custodian or some other specialized tech provider. These are firms whose entire business model is built around one thing: securely managing digital assets for other people and institutions.
And the market here is filled with some huge, regulated players. We're talking about companies like Coinbase Custody and Fidelity Digital Assets, and also infrastructure platforms like Fireblocks. Their whole purpose is to build institutional-grade Fort Knox-level security for the digital asset world.
So how do they do it? Well, they use this incredibly sophisticated, multi-layered security. This includes things like hardware security modules, or HSMs, for storing the keys, and advanced cryptography, like multi-party computation, or MPC, to get rid of any single point of failure. And all of this is backed up by some super strict internal governance to cut down on risk.
What's really fascinating here is that this setup isn't actually brand new. It mirrors how traditional finance has always worked. I mean, custodians have been safeguarding assets like stocks and bonds for decades, while investors still retain ownership. That same trusted structure is now just being built for this new digital world.
So it's really important to get that this isn't some ideological debate about which model is better. The difference is structural. It's just about two different ways of solving the exact same problem. How do you secure ownership in a digital world?
Okay, so let's put it all together, side by side. With self-custody, you get that direct, absolute control, but you also carry all the responsibility. With institutional custody, on the other hand, you're distributing that security risk across professional infrastructure, but it means you're trusting a third party with your keys. It's a fundamental trade-off, right? Control versus operational security.
Look, both of these models are going to continue to evolve and play absolutely critical roles in the tokenized economy. The choice between them really just depends on what the user needs, whether that user is an individual like you or me or a massive financial institution.
And trust me, we are just scratching the surface here. In our next explainer, we're going to dive way deeper into how institutional custody is actually built. We'll look at the specific architecture and segregation models that all the big financial firms rely on. So, if you found this helpful, make sure you subscribe for more short explainers on blockchain and tokenization. And hey, if you have questions or ideas for a future topic you want us to cover, drop them in the comments below. Thanks for watching.